From the outside, the U.S. economy looks sturdy. Growth hasn't collapsed, jobs still exist, consumers are spending, if cautiously. Markets, while jittery, remain near historic highs. That's the backdrop President Donald Trump brings with him as he returns to Congress for his first address of a second term. But strength can coexist with strain, and right now, the U.S. economy is doing exactly that, holding together while pressure builds in places that don't always make headlines. This is not an economy on the brink of recession. It is something more complicated, an economy entering a policy stress test. The consumer engine is slowing, not stalling. For much of the post-pandemic recovery, one force carried the U.S. economy, the American consumer. Strong job growth and rising wages allowed households to absorb higher prices longer than many economists expected. That resilience pushed growth through 2024 and gave the economy momentum heading into 2025. But momentum is not the same as durability. Recent real-time GDP estimates suggest a sharp pullback in activity early this year, not because Americans suddenly stopped spending, but because they're becoming more selective. Holiday spending didn't stretch as far into the new year. Imported goods surged ahead of potential tariffs, and sentiment surveys show something harder to measure but deeply important. Confidence is eroding. Consumers don't need to panic for growth to slow, they just need to hesitate. Inflation isn't gone, it's just changed shape. Inflation no longer dominates headlines the way it did in 2022, but for households, it never really left. Price growth has cooled dramatically from its peak, yet the last mile back to normal has proven stubborn. Food and energy prices flared again at the start of the year, reminding Americans that disinflation is rarely a straight line. The deeper issue is cumulative damage. Years of elevated prices permanently reset household budgets, especially for families without savings buffers. Even if inflation slows, prices do not go backward. That reality explains why frustration remains high and why voters expected faster relief after November's election. Egg prices became the symbol of that frustration, not because they matter more than rent or health care, but because they are visible, frequent, and unavoidable. The administration's attempt to tackle avian flu highlights a broader truth. Some inflation problems are structural, not political, and take time to unwind. Markets are repricing risk, not collapsing. Wall Street entered 2025 expecting gains, just not fireworks. What it got instead was volatility. After 2 extraordinary years fueled by rate cuts, AI enthusiasm, and post-election optimism, markets are now confronting uncertainty from multiple directions: trade policy, government spending priorities, and questions about how much AI investment will actually pay off. Stocks remain expensive by historical standards, which means expectations are fragile. When confidence wobbles, prices don't need bad news, just less good news. This is a recalibration phase, not a meltdown, but recalibrations can be uncomfortable. Housing is the economy's pressure cooker. If there is one sector quietly distorting everything else, it is housing. Mortgage rates above 6% have frozen mobility. Homeowners who locked in cheap pandemic-era loans won't sell. Builders face higher costs and policy uncertainty. Buyers confront prices that continue to rise even as affordability worsens. The result is a market that doesn't function normally and hasn't for years. Shelter costs now act as a slow-burn inflation engine, keeping overall price growth elevated even when other categories cool. All-too-weather, underbuilding, and potential tariffs on construction materials only compound the issue. Housing doesn't just affect homeowners, it influences job mobility, household formation, and long-term economic flexibility. When housing breaks, its effects ripple everywhere. The labor market is strong, but less forgiving. Unemployment remains historically low, defying predictions that aggressive interest rate hikes would trigger mass job losses. That resilience has been one of the economy's biggest surprises. But beneath the headline number, conditions have tightened. Hiring has slowed, job switching has declined, people who lose work are taking longer to find new positions. The labor market still looks healthy, but it has become less merciful. Potential federal job cuts and immigration changes could add friction at the margins. Not enough to crash employment, but enough to weaken the cushion workers have relied on since the pandemic. Big purchases are becoming flashpoints. Few purchases capture economic stress better than cars. Vehicle prices exploded during the supply chain chaos of the pandemic and never truly came back down. Today, Americans are paying nearly $50,000 on average for a new car, far above pre-COVID norms. That wouldn't matter as much if financing was cheap. It isn't. Monthly payments have surged, pushing affordability to the breaking point for many households. And looming tariffs on North American auto imports threaten to push prices even higher, even for vehicles assembled in the U.S. This is where trade policy meets kitchen table economics, fast. Why this moment matters. The U.S. economy is not fragile, but it is less flexible than it looks. High prices, high rates, tight housing, and cautious consumers form a web of constraints that limit how much shock the system can absorb. Policy choices made now on trade, immigration, taxation, and spending will shape whether the economy bends or breaks under that pressure. This is not a crisis economy. It is a decision economy. The next phase won't be defined by charts alone, but by how effectively policymakers manage trade-offs in a world where resilience is no longer free. Looking ahead, expect slower growth, not collapse. Stickier inflation, not resurgence. More volatility, not panic. The danger isn't recession tomorrow, it's misreading stability as safety. The U.S. economy is still moving forward, but it's doing so with less room for error than it's had in years. Smash that subscribe for latest headline and analysis.